In this video, Nouriel Roubini will answer a question as it concerns how to deal with inflation, and then we will react thereafter, explaining some of the terms he mentioned there and also pointing out some of the financial instruments he will mention in that video. So we will play the video, play his reaction first, and then we will react thereafter.
Question: how could increased yields defend against inflation? Well, two aspects of it. One way to try to fight inflation is to cause a recession by raising policy rates. And that's what happened in the past when we had inflation in the 70s. Eventually, we needed a bulk of disinflation where policy rates became 15% to lead to a double-dip recession to kill the back of inflation expectation, but it was very painful. So tight monetary policy eventually can cause a recession and kill inflation. And the second thing, that is maybe the second part of the question, is that, of course, if inflation goes higher, if you are in bonds long term, as the yield goes higher, the price falls and you have a massive loss on your bond portfolio. So you don't want to be in long bonds like you have been for the last 40 years of the bond bull market. You want to be in instruments that are going to be repricing and give you a higher return when inflation goes higher. This is inflation indexed bonds like the TIPS in the US and similar in Europe, or short-term low maturity, say 1 or 2 year maximum rather than 10-year maturity bonds, so that when inflation goes higher and policy rates rise, those yields go higher. They give you inflation protection without having the capital losses that you get by holding long duration bonds. So that's the direction to go.
One of the things he mentioned there, the first of them all, amongst many, is policy rates. So you and I must have been hearing a lot of all sorts of rates, monetary rates, and all sorts of things, interest rates. We are probably by far more conversant with that. We have credit and all that stuff, credit loans and all that. So we definitely understand what interest rates mean. But indeed, what is the policy rate he mentioned there? So policy rate is a short-term reference rate set by most central banks, like the U.S. Federal Reserve. So it is a rate at which commercial banks borrow money from the same central banks. So he mentioned that at some point in the 1970s, that policy rate was up to 15%. So based on a brief search we have done, we can see that we have a rate that it was mentioned here that it was close to that. The Fed increased the benchmark rate to 13% in July 1974, which wasn't the 1973 recession. It reversed course dramatically, lowering the rate to 5.25% by April 1975. So, indeed, that's to some extent a validation of that. So, but in any case, though, that what we just read now wasn't the case of that recession, or rather, yes, wasn't. But I think then they may have been dealing with an inflation. That's why it was raised, and probably led to a recession or something like that. So, okay, now this brings us to some of the instruments he mentioned there. You can see that TIPS, inflation protected bond. So, but this is the iShares TIP bond ETF. So this is an ETF, not exactly the bond. We were not exactly able to find the particular bond. So this is as it concerns Charles Schwab. So you can search or contact your trading platform, and they will probably see what they can provide for you. So as it concerns, this is a summary page. As it concerns Charles Schwab, you can see what's saying there. What is it called? I think there are also options involved as well. Okay. Previous dividend payment was $0.6807. Previous pay date was June 7, 2021. Previous X date was June 1, 2021. That is probably the date you need to have had the instrument, the ETF, for you to have received that dividend. So, and indeed more. There's a summary here. The investment seeks to track investment results of Bloomberg, Barclays, U.S. Treasury, inflation-protected securities. So this is an ETF that is an instrument, an inflation-protected bond or something like that. So it's associated with those tips. So in a nutshell, that's what I'm trying to point out. So the other one is he mentioned the low maturity bonds. So you can see here, the best of them all are these two, the US Treasuries, the US Treasury zeros. You can see 3 months, 6 months, 9 months, 1 year, 18 months, 2 years. You can see that. So the good thing is that they are much more flexible, and in a very short time, things will begin to, in a very short time, if inflation is likely to come and stay as long as up to 2 years. So within that time, you would have participated, gone through that inflation, and also been able to earn some income, because amongst other things, there's a good chance that stocks will fall. According to him, stocks will fall, bonds might also fall. But these sort of bonds were not exactly the type that, these are some of the type that will give you some protection, as he pointed out in the video. So, and he also mentioned some other assets, not in this video, in the same broad video, but not, we didn't play it now. So he was mentioning things like commodities, energy, and those are some of the things that can, those are some of the assets that you probably need to have, in case inflation is confirmed to be prevailing. So let's have a look and see what this 2-year maturity bond is talking about here. You can see it's a coupon of 0.125. Maturity date, you can see that 15th of July 2023. So quantity is, I think 25 is the minimum you need to buy. The price is $99. So not too bad. So, but in any case, though, you have to multiply it. That's roughly 100 times 25. That will be $2,500, or slightly less, or no more than that. You can, okay. Is it what am I estimated total? Okay, so 24. Okay, 24,999. So, all right. Okay, so I got that wrong. So you need to probably what you need to is it? I'm not sure exactly what that is, but it says here price is that, quantity is 25. So I want to believe that it's going to be the minimum you can buy will be 25, I suppose. But sometimes it's usually not the case. So, but in any case, let's click on that and see what it's saying over there. Treasury 0.125, 15th of July 2023. So what is it saying here? Some of the details. Yield to maturity is that is what you will be paid, 0.61%. Okay, so bid 5, ask 5. So I think probably, I'm not exactly sure, I have not traded them before, but in any case though, you probably have a vague idea of what I'm talking about. So yeah, that's how to deal with the inflation as he explained it. And these are just two of some of the assets you can use to protect yourself against inflation, as those are the tips. And in our own case, we showed you ETF tips, and then we now showed you again the low yield maturity, and in this case the 2-year low yield maturity. Okay, so thank you very much for watching this video.